Margin trading. Margin trading is the fundamental basis and major advantage of the forex market. Trading on forex at the interbank level requires heavy sums of money, as one lot equals $100,000 or $10,000, depending on the trading conditions offered by a particular broker. Obviously, most traders simply do not have that much cash to spare. This is where brokers come into play, providing their customers with loans in the form of leverage. Leverage allows traders to make deals that exceed the initial deposit amount tenfold. Leverage can range from 1:1 to 1:1,000 depending on the broker. This means that a customer with $100 on his or her account can open a trading position for $10,000 using a leverage of 1:100. Traders who strike big deals can either gain large profits or suffer heavy losses. In the financial market, a loan is provided for a security deposit, also known as margin. This implies that traders who receive loans for currency operations risk only their own money. A client cannot lose more money than a margin deposit allows. The size of margin in US dollars that is required for opening trade positions is calculated by the following formula, where contract size is the size of one lot equal to either 10,000 or 100,000 units of a base currency. Volume indicates how much of a currency is being traded. Cost is the current price of a currency pair. Credit leverage is the amount of borrowed funds. Finally, USD conversion rate is the exchange rate of a given currency to the US dollar. Now that we know what margin is and how it is calculated, let's take a look at another important concept: margin level. Margin level is the ratio of equity to margin measured in percentage points. It is calculated by dividing the equity, your current funds, by the used margin, your deposit, and then multiplying it by 100. Margin level is an essential indicator that serves as a basis for setting margin call and stop out levels. Margin call is a demand by the broker that the trader should bring the account balance up to an acceptable level. It occurs when the account balance, equity, approaches 30% of the required margin amount for all open positions. Stop out is an order by the broker at which the trading platform automatically closes all positions opened by the trader. This level is used to prevent further losses exceeding the size of margin and the amount of funds available on a trading account. As a rule, brokers set a stop-out level at 10%.